Okay, so let's get started. Good morning, everybody, and thank you all for coming out. We're excited to have you, and we're excited to have David Lugmayer here from TD Bank. He's the manager of TD Bank on East Bay Street downtown, and he's going to talk to you guys about savings today. And we're going to have a lot of time for some questions and answers from everybody. So towards the end, or whenever whenever he's done with his presentation, and I'll be helping him out with that. So yeah, take it away, David. All you.
Thanks, Brandon. I appreciate it. Good morning, everybody. Like Brandon said, my name is David Lugmeyer. I'm the Assistant Vice President and Store Manager of TD Bank down on East Bay Street, downtown. So I'm here to talk to you about savings accounts and budgeting on just realistic stuff. I'm going to give you some background history about myself, why I'm passionate about this, and how I can help you and how you can help yourself get in better financial position in the long run. So a little bit about myself. I've been doing banking for almost 25 years now. I've been in every position you can think of, been a manager for multiple banks, um, been a banker, been a teller, been on anything you can think of, pretty much. I do this because I'm passionate about helping people. I love to help people get out of living paycheck to paycheck and living life. So that includes having savings accounts. It includes making tough decisions with your budget on being able to what you really need, what is a want, what is a need. And that's what I'm going to talk about today. I'm also going to give a little personal background about me, about why I love doing this and why I talk about this. As Brandon's seen me, he and I have worked a couple times together in different um, events about this. And it is very passionate about me because I screwed up when I was younger. I made the mistakes. I know what it's like to live paycheck to paycheck. And I got great advice in the long run. I am by no means a financial expert because I'm always learning. And like any true financial person who is worth their salt, they're always learning new ways to help people out and always out there to make sure that they can pass that information along. So that's what I'm doing today. As we're going through, I'm going to ask questions. Brendan's going to help me filter those so that way I can make sure I can answer them because honestly, Zoom is new to me. I've been on that on your side. So, Brandon, thank you for your help on this in advance. I will need it. So, what the best thing about savings is, like Einstein said, the strongest force in the world, in the universe, is compound interest. And that's what savings account is. Interest on top of interest on top of interest. Everything you put in, you're going to get interest on it. And going by where we're at, the economy today, inflation, rate hikes, as yesterday, most everybody knows the Federal Reserve raised rates again, another 0.25%. Prime rate is now 8.5%. That's the low end of what you would pay when you pay interest. So what I'm here to do is talk to you about savings and not living paycheck to paycheck. One of the biggest things to do is to pay yourself in the beginning when you get paycheck. It's $5 or $10. You put it in a savings account each week, each paycheck. So that way you're building that. That money is going to be building. And every financial institution has savings accounts with interest. So that way you're making interest on that. So depend now when you build up your savings accounts, most banks have tiered interest rates. So the more you save, the better that interest rate's going to be. And this, what the financial experts out there tell you, is you want to have 3 to 6 months of what you need to live on in your savings account. So that way, in case the worst should happen and you lose your job, you have something to fall back on. And its average time is taking up to 3 to 6 months to find a job in some cases, depending on where you live. So a lot of people are needing that money as a safety net. And safety nets are very important. When I was growing up, I was not given any financial education. I was not given financial smarts from my family. We weren't in that position. Didn't get any classes. Got out in the real world. I got handed to me. I spent money. I got credit cards when I got out into college. I blew my credit cards all up and I got into a dark financial area. So what I did is I learned from that. I got myself out. I dug my way out. I paid the payments. and you have to do that. But I never learned about savings until I got into banking 25 years ago. Then I actually learned how to save. So what a lot of people don't realize is you spend money more than you think. You spend money, you double pay on a lot of things. A lot of people out there have subscriptions to streaming services. They have multiple subscriptions. They have Disney Plus, they have ESPN Plus, they have Hulu, they have Netflix. There's areas out there that you can go to and you can download, you can get free TV. My job is when I sit down with people who say they can't save, I look at their budget. I look at where they're spending their money. They're spending $6, $10 a day for coffee. Go to the grocery store, get Folgers or whatever you like, make it at home. It saves you a lot of money. You take that money that you're saving, you put in your savings account. You pay yourself first, then you pay your bills. Whatever you have at the end of your payment cycle, at the end of the month, you put more that money into your savings account, and then you start your month over. So you're always going to be adding to your savings account. The reason you do this is because when you do that, you're going to build it, it's going to get larger, and you're not going to be worried about it. You know it's going to be there. The other thing I tell people to do is if you have direct deposit from most businesses will give direct deposit to their employees. Have your direct deposit part of it go to your savings account. So it's out of sight, out of mind. You're putting your money in your savings account already, and you're not even thinking about it. And then you're still paying yourself after that. Then you pay your bills, you do your life, and then you save more money again. The reason that you want to do this is a couple reasons. In the long run, it's a good safety net. Also, you're paying your bills on time. That's going to down the road give you better interest rates on credit cards, on loans, on car loans, on home loans. Average home loan as of yesterday was the interest rate was 6.8%. 2 years ago, it was around 3. People were paying more than $1,000 a month more for some of these homes than they would have 2 years ago. How many of you can afford $1,000 a month more than you did? It's a big chunk of change. And if you don't have the savings account to be able to put down a large down payment on those homes, you're going to be paying that money. You're going to have to come up with that money somehow. And that's where you're going to have to cut corners in your budgeting. One of the biggest things on budgeting is, again, savings. Pay yourself, pay your bills, pay off your credit cards. Because if you pay those off quicker, you're going to be paying less interest. And then you can take, again, more money that you have left over at the end of the month, put that back into your savings account and build up your savings account. One of the things I always tell people is I wish I would have gotten into savings a lot earlier than I did. It took me years. I spent about 5 to 10 years without a savings account. And if I would have just put a couple bucks away a week, $10, $20 a week, I would have had a couple $1,000 sitting there within a few years with no problem. Just sitting there. This is money I didn't need. This is money I was spending on back in the day, Blockbuster videos. If you remember that, if you know what that is. Old stuff. But how many people out there have savings accounts? Brandon, can you see how many hands go up on this?
So guys, put your hands up if you have a savings account. We got one hand up right now. Let's see, we got Taylor. Anybody else? You guys got savings accounts? You could confirm it in the chat if you'd like to. How many people out here have? We got 2 hands, 3 hands. Let's see, anyone else? Three hands up so far.
Okay. And how many people do we have here today?
We have 15 at the moment.
Okay. So that's about 20%, about 20%.
5 hands now. It's growing a little bit.
33% now.
Yeah.
Good. Now, I don't know y'all's age. That's if you're under 18, that's great. One thing I tell young youth that are living with their parents, get a savings account if you do. And have them, when you're doing a job, have them match your dollar for dollar what you put in your savings account. Have them match your dollar for dollar. It encourages you to save. It encourages them to help you save. And that way you can build up that savings account better for school, for a business that you eventually want to go on, or whatever you're looking for. The savings accounts are great because it gives you a good footing in the future. Because in the future, if you have a savings account and you have a good nest egg, you can look at doing a lot of different things with your life. You can go into a business for yourself. You can go on trips. You can buy a house, buy a car, low interest rates or none. If you have enough money, you can pay cash for it. The savings accounts are a great safety net also when you are a homeowner. When I had my second home, my first home, within 30 days, stuff started happening. It was an older home. And if I didn't have that safety net, I was going to be coming out, that money was going to be coming out for a credit card, and I was going to be paying interest on it every month until it was paid off. Water heater explodes, your deck collapse, you have a pipe explode. You never know what's going to happen with a home. You never know what's going to happen with your car. My Jeep the other day had to have work done to it because of a shock break. One of my suspension pieces broke. Cost me $1,000. Glad I didn't put it on a credit card because that's going to be expensive. You have a savings account as a safety net. Without that, you're going to be never going to be ahead in life financially. You might think you are, you might think you're doing good, but when you actually look in the reality of your finances, you're just living paycheck to paycheck. And if you lose your job, what are you going to do? Where are you going to go? How are you going to feed yourself or your family? These are questions that can all be answered by putting money away in a savings account. You don't have to do it with me. I promote TD because I work there. You do it where you have your bank account. You do it with a credit union. If you don't have a bank account, don't have a credit union, find one that's close to home, close to your job, so you can make sure you're putting that money away instead of walking around with it and then spending it. Sure, I promote TD, no problem. You can come to me, I'll help you all day long. But reality is, banks are all the same. We all work with each other to help their communities. As Mindy knows, she has multiple banks that we work with her on different events and different programs to help the communities. We're here to help you out. We're here to help you financially be safe. We're here to get you financially strong. We don't want people to be living paycheck to paycheck. We don't want people wondering where they're going to get their next meal. We don't want people wondering if they're going to have to pay for gas or medicine. That's not our jobs. Our job is to help you day-to-day finances, to figure out banking. We know banking. That's our jobs. We understand it. We help you implement it into your daily lifestyle, however that is. But one of the biggest things you can ask any banker, any bank across the country, savings accounts are the best things in the world because you can have them. Anybody can have them. Your child can have it when they're born. Just need to walk in with a social security number and their name. We'll put a savings account for them with you as a custodian. Start putting money away for your child, for college, for trade school, for whatever. If you don't have a savings account, you're really not doing yourself a financial justice. You're really doing yourself an injustice because you're not giving yourself the best financial footing you can have. There's multiple ways of saving money. You get a couple bucks, put it in a savings account. You have a couple $1,000, a couple $100 that you don't want to touch. You go to your financial institution, put it in a CD, a certificate of deposit. What that is, if you're not familiar with it, is you put money in, you lock it up. It's locked up for a certain amount of time, but you get paid higher interest than what you do in a savings account. Savings account you have access to. You can withdraw money if you need to from the savings account. The CD, you lock it up. If you touch it, they're going to penalize you because you're promising to lock it up for a certain amount of time. But CD rates right now in a lot of financial institutions are really nice. As long as you belong to them with a checking account or however their rules and regulations are for that bank or that credit union, you can make some good money off that in 6 months to a year. And then you put that back in the savings account. You also, with your jobs, a lot of jobs offer what's called a 401k. It's a retirement plan. So when you work, they're putting money away and they ask you if you want to put a percentage of your paycheck away. That's pre-taxed. So it's money that you've already earned that goes into that. And then they match you in a lot of cases up to at least 3% for most companies that offer that. Some are higher, some are lower, but the national average is 3%. That's money you're putting away for your retirement. That's money that they're matching you, so you're doubling it up. And that's money that's going to be able to help you long term. When you leave a company, your 401k does not go away. A lot of people have thought that they lose it when they move. You don't. You can transfer that. You talk to your bank, say, I'm now at another job. I had a 401k at my previous job. What can I do with it? What do we do to put this in to make sure my money is safe? Because again, this is money for your retirement. A lot of people don't realize that they have old jobs that they left that they still have 401ks that are just sitting there, and they do get a yearly fee for being there in most cases. So you're losing money. I don't like losing money. I've lost money. I did it when I was younger. I lost a lot of money. I was stupid. My job now is to help people learn from my mistakes and learn from my knowledge that I've gained over the years. Anybody here have a 401k? Raise their hands.
All right, guys. Anybody got 401ks? Let's see. We got 2 people
Okay.
so far. We put it in chat as well if you'd like.
Oh, I see the chat at the bottom. Yeah.
All right, so it looks like we got 2.
That's good. I encourage you, if you have a job that offers it, get it. My wife just finally had the option of getting it after being at her job for 6 months. I told her to do it, and she's not putting money away for her retirement, which is hopefully our retirement down the road. Don't tell her I said that, but anyway. But I'm putting away on mine too. So, but remember, when you leave a job, if you leave a job, most people have an average of anywhere from 6 to 8 jobs throughout their lifetime now, on average. Your 401k can be moved. It doesn't have to stay with your previous employer. It can be moved. It can be moved into different options, savings options at financial institutions to make sure you're financially stable for your retirement. That's what the 401ks are for. Again, you also have IRAs, which is an individual retirement account. Most financial institutions offer this. That's where you're putting your money in at your choice throughout the year, up to a certain amount by federal regulations due to your age. Again, talk to your tax advisors about what you can do. I am not a tax advisor, and I'm not going to answer tax questions. I'm not regulated, I'm not authorized to do that. But I can advise you to talk to them about your 401ks, about your IRAs, about what you can put away, what your limits are, how to save money the best for your tax bracket. That's what your accountants are for. They tell you what to do, you come talk to your banker, they do it for you. They make sure you put in the right plans that you need to be in according to what you've been advised by your advisor. Everybody can get an IRA. Doesn't matter your age or what. Anybody can get it, and it's another way to set up for your retirement. Because IRAs, they're there for you for when you're supposed to be in your 60s. So you have time to put them, even if you're in your 30s or 40s. Start them. If you don't have one, get one. They are not the highest yield of interest, but they pay more interest than a regular savings account. Not as much as a CD. Now, there are things called IRA CDs with some financial institutions. If they offer that, that is a great thing. If you have the amount of money you can put into it to lock it up, that is a great thing because you're not supposed to touch your IRAs. You touch them, you get penalized by the government because they're for your retirement. But if you do that, you do those things, you're going to have a good retirement. They say the average person needs to have over $1 million in retirement to be set for when they retire. I don't have $1 million yet, so I'm still working. I know a lot of people are still working, and I'm hoping to have that $1 million total by the time I'm in my late 60s, early 70s. Still got about 20, 30 years to go. So hopefully I'll get there. But I have to also live long enough to use it, which I'm hoping I will too. The thing is, with the savings accounts, Anybody can do them. With your IRA, anybody can do them. CDs, anybody can do them. 401ks have to be done through your employers. Anybody have any questions so far?
Anybody have any questions? Raise your hands and put it in chat if you'd like. If you'd want to raise your hand and unmute your mic and ask David, that's perfectly fine as well. Any questions, guys, about savings, IRAs, 401ks, CDs, any of that? Savings goals, questions, anything like that? No, not right now.
That's fine. The other thing I'm here to talk about is budgeting, which I touched a little bit about, which does hide your savings account into savings. Sit down with if you're by yourself, sit down with a pen and pencil, write out and look at what you really spend money on, what you really are spending money on. Don't sugarcoat it. A lot of people say, "Oh yeah, I buy coffee here and there." Go through your app, go through your statements. Go online, look at how much you're actually spending on coffee. I had one customer come in, they said they couldn't find $50 to save a month. $50. And I had them come in, we looked at their statement. They had 3 streaming services. They bought coffee every day from Starbucks. Hey, that's what they like, that's what they like. They went out to eat at restaurants and fast food every day. See, a question came in.
Yep. Renee asked,
Okay.
what is the difference between an IRA and a Roth IRA?
Okay, there's actually 3 IRA types out there. There's a SEP IRA, which is actually funded by your employer. Then there's a traditional IRA and a Roth IRA. One is actually pre-tax, so you're paying taxes up front on it. So when you actually withdraw it down the road, you've already paid your taxes. So you're actually banking that the tax rates are actually going to be lower now than they are down the road. The other is you pay taxes when you withdraw it. So it's going to be taxed down the road. And that one is you're basing that, you're thinking that tax rates are going to drop. Now, which one's going to be right for you? You need to talk to your tax accountant because of your tax bracket. They'll tell you which one to open up, and then the banks can do that for you. But that's all going to be dependent on your tax bracket, and you need to talk to your tax advisor on which one's going to be appropriate for you. But one's pre-tax and one's taxed afterwards. Hope that answers your question.
Any other questions, guys?
Okay.
All right. Continue, David.
Excuse me. So we were going through the budget, 3 streaming services, buying food every day at fast food, McDonald's, Hardee's, Chick-fil-A, all this stuff. And they were buying groceries. And then when we started talking and found out they were throwing away food because they were eating out all the time. So looking at different things like that, we were able to sit back and sit down and have an honest discussion about their spending habits, where they were spending their money, what they could do to save money. They weren't putting any money away in their savings account. They were living paycheck to paycheck because of the way they were spending their money. After we sat down and talked, and that's the thing. I don't pull punches. My clients know this. I don't sugarcoat anything because it's not fair to you. It's not fair to my clients. We sat down, we went through it. I told them we needed to come up with ways to save their money. One was, and they really hated me on this, stop going to Starbucks, buy your Folgers, make it at home. They had a coffee machine at home, never used it. So they went and they started buying, they even, instead of Folgers, they got, evidently you can buy Starbucks and brew it at home, I guess, in a bag. I don't know. I don't do coffee, but Brandon knows that one. And we started talking about actually making their lunches and taking their lunches to work. Within 3 months, they had over $500 in their savings account in 3 months. So they were able to, and they didn't get rid of their streaming services. They had to have ESPN Plus, they had to have Netflix, and they had to have Disney Plus for their kids. Okay. But the wants and needs they had to sit down and have an honest look at their wants and needs. The wants was they wanted to eat out all the time. Did they need to? No. Did they need the streaming services? In their opinion, they did. I think they could have gotten away with just Netflix personally, but that's their call. It's still their finances and they still have to deal with it. But the thing is, they were able to start saving on average of about almost $200 a month. So in 3 months, they had over $500 in their savings account. They also went and did what I told them to do. They went to their employer. They had 5% of their paycheck. They did a percentage, not a dollar amount, but a percentage of their paycheck because it was a variable paycheck. They were hourly, and they had a percentage put into their savings account before and the rest of the money went into their checking account. Then they still paid themselves another $20 a paycheck, just $20. But that percentage plus the $20, and plus at the end of the month when they paid all their bills, they took what was left and put it back into the savings account. That was starting to build up. After the 3 months, we sat back down and we had our sit down again, met back with them as a follow up, and we looked at what they were doing and asked them how they were feeling about it. They said that now they weren't worried about money, even though they only had $500 set aside now, nowhere near the 6 months of what they need, like these experts out there suggest in the markets. But they said their whole outlook on their finances have completely changed and they feel more confident. The confidence is amazing from when they were wondering where they were going to be able to save money and how they were going to, and if they did get hit with tragedy. Here's a little tidbit. Here in South Carolina, we get hurricanes, we know that. I mean, we have some disturbances off the coast right now. Nothing big. It's part of our life. That's why we live here. Is mild winters, hot summers, and maybe a hurricane here and there. No earthquakes, really. That's at least for me. If your home gets hit by an earthquake or hurricane and damaged, your deductible is not your base deductible. If it's a named storm, your deductible goes up. Check with your insurance company of what your deductible is if your property is damaged by a named storm. A lot of people think, oh, my property deductible is $500, $1,000, $1,500. It's true. When a storm comes through, a tree drops on you, $500, they take care of everything else. A named storm, it could be as high as $15,000 to $20,000, depending on your insurance coverage. Talk to your insurance company, whoever does your coverage with your homeowners, and find out. Because a lot of people don't realize that they don't have enough to even pay their deductible if we get hit by a named storm. I'm not your insurance policy carrier. Again, talk to them. My job is to help you find ways to save money and why you need to save money. I had a customer years ago. We got hit by a storm. They thought their insurance was going to be $500 to cover the tree branch that went through their living room. They didn't. They sat with a hole in their house for almost 6 months because they couldn't cover the deductible because they didn't have it set aside. Some of the things I say are blunt, but they have to be. Because if you don't hear the truth, if you just hear sugarcoating stuff, you're not going to pay attention. If I lie to you, doesn't do you any good, doesn't do me any good. If I sugarcoat it, doesn't do anybody good. That's why one of the things that Brendan and I talk about a good bit is that we respect each other because we're honest with each other and we tell each other what's going on. I mean, I've been working with Brandon for what, 6 months now, almost a year, somewhere in there. And he and I have had some great conversations about savings accounts and about budgeting. I tell him the same thing I'm telling y'all today. Learn to cut back. We're going through economic times that are unseen. You can watch the news every day and everyone say, oh my God, this is happening, this is happening. We've never seen this before, and they're true. Interest rates are at a 22-year high. And the Federal Reserve said they're going to raise them again by the end of the year. The inflation it's been unprecedented. You've seen the prices at the grocery stores. How are you managing that if you don't have a savings account, you don't have extra money in the bank, just in case? That wallet's looking a little bit thinner. That outlook on getting those eggs at $7 a carton, which is ridiculous, is being questioned. Do I need eggs today, this week? I'm supposed to get you in a position where you're not thinking those questions. That's what your banker is for, and that's what we're all here for. We're all here to help you save. We're all here to help you be in a better position. Now, is everybody out there for your best intent? No. I'm honest. There's some bankers out there that are out for their own good. That's reality. But there are some really good bankers at a lot of good financial institutions throughout this country, throughout the state, throughout Charleston. And I know them. I've met them. I have friends at other banks. I have friends at credit unions. And they're all trying to teach people the same thing. The hardest part is getting people to sit down and listen and know that we're here for your better good. We're not just blowing smoke to get you to get a savings account just to get a tick mark. Banks don't do that anymore. That's the 80s and 90s. Banks are here for you. Banks are here to help out. Banks are here to help you get a savings account for your future, a retirement account for your future. So you're not paying these high interest rates. You're not going to be deciding gas, food. What am I going to pay for today? Medicine. Medicine is ridiculous. Come on. $100, $200 a month for medicine is not unheard of anymore. And that used to be a grocery bill. Now grocery bills are $400, $500 a month. People have to learn and sit back and pay themselves first to make sure they can be able to have a savings account. They have to have these savings accounts in case the worst should happen. Reality is reality. Any questions so far?
Does have any questions for David? Put them in the chat right now, or raise your hand and feel free to unmute your mic and ask him. Any questions? Let's see.
And I'd love to hear from y'all what you think about savings accounts. Why don't you have them?
We had 5 people who had savings accounts, I believe, earlier.
I believe so.
If anybody wants to share as to why you don't have a savings account, or you don't have, or you have any concerns about savings accounts or anything, please feel free to share them. All right, I don't think we have any questions right now. Feel free to continue, David.
I'm getting pretty much usually a little bit more interaction. So, but on budgeting,
Oh, we actually do have one. We actually have a question. Can you talk more about high yield savings accounts?
Sure. High yield savings accounts, usually for most financial institutions, you have to have a larger amount of money. Where I work at, we have tiered savings accounts that start off at a couple $100, and then when you hit a certain threshold, keeps going up. Now, high yield savings account, usually for most financial institutions, start off around $100,000. The reason why is you're putting $100,000 in there, but you're going to get a higher interest rate. Right now, I'll use TD as an example since that's who I work for. We have a high yield savings account that pays 4% interest on the APY, on the percentage yield for 100,000 and higher. The reason banks do this is they want you to save the money. They want you to keep the money here. And the more you keep it with the bank, one, the bank uses its money to loan out to people, to help them get home loans, help them get construction loans and stuff like that. So the more money they have in deposits and savings, they're able to actually use a percentage of that by federal regulations to loan out to other customers. So with the high yield savings accounts, there's other banks that I know that start at 250,000. Most of them will start paying higher interest rates though at 100,000. Now you got to remember the yield is over a year, not per month. Per month, if you take it out, it's always going to be a little bit lower. But if you leave that money in there and let it earn on interest, that's where you're going to get, like with TD, that's where you're going to get the 4% over a full year period. You take it out a little bit earlier, or you take some out, then or you move it around a little bit, take out the interest. You're not going to be earning that high of yield at that point because that final number that each banker is required to tell you when they say annual percentage yield is if you leave it alone, the same amount of money, and it's earning interest on interest on interest, and you don't touch it for that full year. Now, if you add more money to it, of course, that yield is going to be the same percentage, but you're going to make more money because you're adding to it. Being a savings account, you can always add money to a savings account at any point in time. Now, you can withdraw from it too. You usually have 6 withdrawals per month by federal regulations that you're allowed to do. But when you take out of that, that yield percentage is still going to be there, but you're going to be on a lower amount of money, and you might even fall into a lower tier bracket if you take out too much, and then you're going to lose that percentage.
All right, awesome. We got one more question from Kaylee Campbell. She said, what are the three main types of savings accounts?
Really, there's not main types. All savings accounts are savings accounts. A lot of banks just put fancy names on them to just differentiate them from one to another. You have minor savings accounts, which are for children. The minors are not allowed to access them. The parent or guardian that opens the account is the one that's going to be able to manage the account until they're the age of 18, and that money should be handed over to the child at that point and put into their name. Then you just have savings accounts that are called premier savings accounts, high yield savings accounts, spectacular savings accounts. They're all the same. Savings accounts are savings accounts. Now, you do have what's called a money market account offered by some financial institutions, which is a hybrid. It's a hybrid between checking account and a savings account. So you have a little bit more interest than a checking account, but you have check writing capabilities. It's a good account for people that need to have access to that. Usually most banks and financial institutions would have that for people that have a little bit more money in the savings, and that way they have minimum balances of $5,000 to $10,000 to have in them, but gives you check writing capabilities, but a little bit more interest, but not as much interest as a savings account. I always call them a hybrid because you get the check writing ability, you get on it, but you are still limited on how many checks you can write within like a savings account, and you get a savings account rate, but not as high as a true savings account because you have those checks to write out with. So you have the minor savings account, you have a money market savings account, which a lot of them, then you have just a savings account, high yield, premier, whatever. All they are different ways of packaging the same thing. And all it is a savings account. And one of them will be just straight, this is your rate, no matter how much you have in it. Another will say, oh, it's tiered at like 500, you get this rate, 1,000, you get this rate, 1,500, you get this rate. Then another one might be 25,000, 50,000, 100,000, and that's all there is in savings accounts on their names and stuff. It's all just like glitter, sparkles.
Awesome. We have another question from Charlotte. She asks, what's the difference between API and interest rate?
APY is annual percentage yield. So that is what you're going to earn overall. That's what the federal regulations are that we have to quote on everything is the overall what you would receive in 1 year. So that way you can compare apples to apples from one institution to another. The interest rate is what you're paying monthly or what you'll get paid monthly. So if overall the monthlies are what they'll total up into the APY. So, but you'll always hear annual percentage yield when you're talking to somebody who knows what they're talking about. That's been in the business for a while because we know that's what we're required by federal law to do. So when they say our savings accounts pay 4% annual percentage yield of 4%, the interest rate 3.96. That's what it's going to be about most. And that's the 3.96 if you leave it in each month and you take it out at the end of the month, you're going to get the 3.96. But overall, if you leave it in with the interest on interest, you're going to get the annual percentage yield. But you should always want to look at the yield because that's what you're really going to get if you leave it alone for one full year and with overall growth. And that's what the banks should be quoting you because it's a federal regulation that we have to do that. And so you can compare apples to apples instead of apples to oranges.
Awesome. We got another question as well from Kaylee. She asks, what are the limitations of a savings account?
Most limitations on that is just withdrawal limitations. Federal regulations limit you to 6 withdrawals per statement cycle. Now, that is you actually taking out money. Now, if you go into your financial institution, you can transfer, you can move money around with one of the bankers or tellers. That does not count against you because it's internally and it's all done inside. But with actual withdrawals on savings accounts are the things that are regulated by the government. What could happen in worst case if you violate the withdrawal limitations 3 times in 3 months inside of 1 year? The financial institution usually will be required to turn your account into a checking account at that point, and you will not be able to have a savings account at that point because you're not following federal regulations. It does happen, but you do get notices saying, "Hey, that you're not handling this properly within federal regulations." You get a warning from the banks a couple of times, but the banks are required to, at a certain point, turn it into a checking account because you're handling it more as a checking account instead of a savings account. You have unlimited deposits into it. Now, a lot of people don't understand and they get it mixed up with CDs. CDs, when you put the money in, you cannot add money in, you cannot withdraw money. If you take the money out, then you're going to get penalized and you can lose part of your principal money if you take it out too early. So they have up front, they will tell you what the penalty amounts are. So say you do a 1 year CD, just that throwing it out there, 12 months, and you're getting 5% on the APY. The annual percentage yield is 5%. But if you take it out before 3 months, in the first 3 months, you're going to get a penalty of $25. Well, if you haven't earned that $25 yet in interest, when you take out that CD, they're going to take it out, whatever it is in interest, plus your principal to make up that penalty. So in a CD, if you do a withdrawal on that too early, which you're not supposed to do because you're locking it up, you can actually lose principal money out of that. So that's something you got to think about when you're doing that. But on a regular savings account, 6 withdrawals is your limitation. Unlimited deposits into it. You can go into the bank and do transfers into your checking account, so that way you don't have to take that six marks. Um, so that's usually in most cases. But also when they open it up, if your financial institution has any extra regulations on that type of savings account, they will tell you at the time if there's anything, because you might have a special promotion going on. And for that promotion, they might have something going on and that they have to say, this is also part of the policy for this savings account.
All right, awesome. Any other questions, guys? Please feel free to put them in the chat whenever you have a question. David is keen on answering them, and we'd love for you guys to share more of what you're thinking. Any other questions right now?
And also, what do you think about what I'm doing? Am I giving you information that is actually relevant? Because I mean, I do these. I like to know what people like and what they don't like out of these meetings that we do. As Brandon knows, I have.
Yeah. All right, here we go. We got Kaylee again. How do you earn interest on savings?
Leave your money alone. Is the easiest thing. You put money in there, and a lot of people think they're going to be millionaires overnight. They're not. I was actually talking to one of my friends last night about this. He works for South State, and a lot of people do rate shopping, and they try to move their money around bank to bank to get the best interest rates, which is great. But it really doesn't do anything. When you're talking a 0.25% of interest, unless you're talking $1 million, that 0.25% is not going to be much. Put your money in there, let it work for you, let it work smarter. Talk to your banker, to whoever your banker is, go to them, say, hey, I want to earn more money on my savings account. Do you have a new savings account? Do you have other options? My bank, we just rolled out a new option about 6 weeks ago. And I've been calling my customers on it. It's like, look, you're in this account. I have something better now that can make your money work better. You work hard for your money. Make your money work for you. That's what I always say. It's like you work your butts off to get this money. You go to work every day. You bring it home. Make the money work for you. Overall, it's going to take time, but as long as you let it sit there and accrue, it will earn interest and it will build up over time. You got to remember when you do 401ks with your job, A lot of that is in stock market and however they have it, but a lot of them put it in the stock market. They will earn interest faster, um, but also they can lose interest. They can lose money faster too. Savings accounts, they're FDIC secured, so you're going to be protected up to $250,000. They're there for you. They're easy. They're liquid. When you hear the term liquid, it means easily accessible to you. Very quickly means you can go to the bank and get the money at that point. Um, a lot of people don't realize that's what that term means. But if it's like in an investment, it's not going to be the same. When you talk to your investment personnel, I can get you the money in about a week or two. That's not liquid. That's accessible, but not liquid. Savings accounts, when you're talking to your credit union and your financial institution, are liquid and they're there for you in an emergency. But you gotta realize what is truly an emergency. Not being able to get your Starbucks on a Friday afternoon is not an emergency. Not being able to get your medicine, that's an emergency.
All right. Nikita asks, any recommendations or thoughts on on a college savings plan?
They're great, especially you start them up for your children when they're born. 521, I believe it's called 529s. Um, we don't do them in the branch that I work at, so we have personnel that do that. I have partners in my bank that do that for that talk to my clients for me on that. They're great because as long as the money is used for the schools, then the money's there for the students. Um, do they add any interest? Generally not. It's just like a savings account, except it's just earmarked for students to use, for them to use for students. There can be some other benefits if there's tax purposes. Again, that's where I'd have to defer you to your tax accountant on that because they will tell you if you can get any, if it can benefit you in your taxes, if there's any tax breaks or not. If there's not any tax breaks, then a savings account is a savings account. This is a savings account. It's going to be there for you. That's great for students. You got if it started when they're born, 18 years of a savings account will yield a lot of money and a lot of interest over 18 years. And it will be a good foundation for somebody to go to trade school or to college or to junior college or community college or university. It's an amazing thing, and I've helped a couple people at banks that I was at that did offer them from my position. Right now, I'm at a bank where my position does not include a 529 plan, but we do that all banks do offer them in some form or fashion, and they make sure that now the catch to that is, in a lot of ways, it used to be, and I'm not an expert anymore on it because it's not something I handle, but the money was not used for the student to go to college or for anything college related. There was a huge tax burden after the fact. Now that might have changed. That's again where you need to talk to your tax accountant and talk to your financial planner if you do a 529 plan. But if they used it for anything but college, then there was a tax burden that had to be paid after the fact. That was upwards of 30 or 40% back in the days. Again, talk to your tax accountant. I'm not a advisor, and I'm just letting you know that. But there used to be a penalty. I don't know if that's still the same or not.
All right. Awesome. Any other questions? Anyone else have any questions for David? All right. Charlotte has another question. She says, what form do you get from the bank to report the interest earned from a savings account on your taxes?
Um, it's a 1098, I believe. But this is the thing: if you earn less than $10 in interest, you're not getting anything from the bank because I want to say it's a 1098, but I'm not positive. I have it saved at work. And but if you earn less than $10 in interest, you don't receive anything because the IRS doesn't care. If you earn $10.01 and more, you'll be getting a tax form in February from your late January or mid February from your financial institution because anything over $10 has to be reported. $10 and below is not reported by bank financial institutions to the IRS because the IRS just doesn't care. Um, so I can't remember the exact form. I have it at work. Unfortunately, I'm not there, and so I can't pull that up right now. I'm sorry.
Is that on like on a line item sort of thing,
Yeah,
like just within a bigger form?
yeah, it's just a form. It just says this is the interest you received for last year in your savings account. That's all it is.
Okay. Yeah, awesome. Any other
But,
questions?
but if you're in less than $10, you're not going to get one. I have a lot of people come in February. Where is it? It's like you're at $8. You're not getting one.
Yeah,
They
there
panic
you
over
go.
it. They don't realize that.
All right. Anyone else have any questions? All right. If you have any questions at all, feel free to type them in chat, and David will answer them.
And Brandon, anything you want to add?
Let me think. Uh, you covered a lot. We'll see. What's the best way to plan for long-term savings?
Have a goal. And I actually would recommend having a specific savings account for that item, especially if you want a car, or if you want a house, or if you want a vacation. Set, set up a savings account for that specific item and start saving into it. And that way, what you can do is you can look at your time frame. Say it's 24 months. You want to go on a big take a cruise. You need to have $2,400. Right there, you know you're going to need to put away $100 a month to make sure you can get the bare minimum coverage on that of $2,400 for 24 months. So set up a savings account, put money into it every month. That way you're breaking it up over the amount of months that you need it. And if you put extra in, great, you're going to have more money. Get that money in earlier and get it over the 2,400 so you have a little bit extra spending at when they make landfall and you want to go buy something touristy. But like right now, I actually have three savings accounts going right now. One is my wife and I are going to fly to Europe next year, so we have that in a savings account. One is just a regular savings account going for me, and then one is for her. We have individual savings accounts because we don't want to. We also want to surprise each other here and there, like with a little gift, something like that. So we each have our own checking account. We each have our own savings account. We do have a joint checking account for the household bills, and that's where we do our budgeting from. We each put a certain percentage of our paycheck in that joint account to make sure we cover our bills, and that way it matches our budget of what we plan on spending each month. Then the rest goes into our savings accounts or into our personal accounts, so we can buy each other little gifts here and there. But we're not breaking our budget, and we're not also like one of the things we do. Our budget is for our household, so it's our monthly bills, electric, roof, everything, and also including what we expect to pay for food, what we've been watching on average and stuff. But our gas for our vehicles comes out of our own money. So that way it's not a surprise on the joint budget of where's 40 bucks just went to. So we do that with our budgeting, and that's something I always recommend for a lot of families because a lot of them just dump it into one account and they don't know what they're doing day to day. Somebody might buy gas, they both might buy gas on the same day and then not tell each other, and then they're watching the wait a minute, where did this money go? The part of budgeting is being smart about how you do your money too. And I tell a lot of couples, you do one and you put equal percentages in because not everybody makes the same exact money every week. One might make more than the other. Well, fine. Each of you put 80% of your paycheck into your checking account. Put 5% of your paycheck into your savings account. Put 15% into your personal checking account. So that way you can take care of knickknacks. I can go out and go to the gas station, buy gas and a Pepsi, and it doesn't affect my budget for the household. Doesn't affect my savings account. Comes out of my regular checking account. And then at the end of the month, I was left in my checking account, I put it in my savings account, and I start over with my next paycheck. But that's how we'll do with the savings accounts. You do it over, make a separate account. The banks will be glad to set up another account, earmark it for whatever you want to do, and then find out when you have your goal of how long it's going to, when it's going to be, how much it's going to be, divide it by those months. And I always actually knock back a month. So that way you're not going up to like 24 months. I figured it out after 22 or 23 months. So that way I'm not scrambling at the last month to make sure I have enough money personally. And that's what I recommend.
Thank you, David. Yeah, that's great. Any other questions in chat, guys? Any other questions? I'll try to think of another one if you guys don't have any other questions. Let's see.
Mindy, you can ask too. Just saying.
Any questions, Mindy? Any questions, anybody at all? Oh, a question about the gift cards. Okay, so the gift cards, if you want to enter into the gift card giveaway, make sure you put your email and your name in chat. And if you do win, we it's a random giveaway. We'll enter all of your names into a wheel, and one of you guys will be picked for $100 gift card. However, you must be you must be able to come in person or give us an address to send it to. So last call real quick, because it's already 10:57. We're almost to the end of the session already. So last call for that. If you guys want to put your emails in chat, I got a lot of you earlier. So anybody else that wants to add or enter into the giveaway, please do so right now. And then if you guys have any other questions as well for David, with the limited time we have left, please feel free to ask that.
And the thing is, if you want to reach out to me, you can. I mean, I'm at TD on East Bay. You can come down there. You can reach out to Brandon. He has my email address. He can provide it to you. I don't hide from anybody. I'm always available. Mostly, I mean, I'm off today and I'm doing this. I mean, I make sure I reach out to people and take care of them. So if you have questions that you don't feel comfortable asking on here, feel free to go ahead and ask me personally. I'll be glad to answer anything. What is a good amount to have for an emergency? I learned how to read that now. I see them on there. Most financial people will tell you 3 to 6 months of your monthly bills. So if you spend $2,000 a month in bills, including food, rent, mortgage, electric, then you're going to want to have at least 6,000 saved at minimum up to 12,000. The reason why is because if you do lose your job in some of the markets right now, the job market is not good in some areas, better in some, but most people it takes 3 to 6 months to get another job. So that's why they're recommending 3 to 6 months of your monthly bills is what you want to have in your savings as a good safety net.
All right. And like David said, if you guys have any questions, feel free to go down to East Bay Street and check out his branch, TD Bank. And or feel free to email me and I can connect you with David as well.
Brandon, you still need to come down too.
Yeah.
It's been a pleasure. Some great questions. Thank you, everybody. I appreciate being able to have some of your time and have the opportunity to hopefully give you something that you can work with and help you out financially. And I hope you learned something. If you didn't, pass along though. Either way, talk to people, and I hope it was worth your time.
All right. Thank you so much for coming out, David. It was a
Thank
pleasure
you.
having you, and thank you for sharing your perspective and your experience in banking. It's definitely helpful. It's definitely helpful.
I appreciate the time, and it's always a pleasure. Thank you.
Thank you very much. All right. Last call for everybody. Put your name in the chat. I'm going to be recording it right now, writing it down to send you guys set up for this $100 gift card giveaway. Take a couple more minutes just to do that. If you need to get going, David, feel free to get going. Thank you so much again for showing up.
No, I can stay on until we're done, and just in case somebody has a question that they thought of, I have no problem.
All right, awesome. If anybody has more questions for David, Renee actually asked a question. She said, "Was a good amount for an emergency savings account?"
Yeah, that was the 3 to 6 months of your monthly bills. So sit down and look at what you actually spend. I'm not talking Starbucks. I'm not talking Netflix and stuff like that. I mean, your real bills, your electric, your water, your rent, your mortgage. your car payments, your insurance, the things that matter. You can go without Netflix. You can go without coffee. It might suck, but you can do it. But your real bill is what you need 3 to 6 months to, that's what you should have in savings all the time.
All right. Let's see, anybody else? Thank you, everybody. Thank you for all showing up.
Thank you.
Have a good one, guys.
Thank you, everyone.